Hi there, everyone, and welcome to this month's edition of On Track. Rob McGregor here. It's the 27th of September as I record this down on the beautiful Gold Coast, down here for my daughter's 30th birthday. Hard to believe I've got children into their 30s. It's pretty awesome though too. So anyway, we've got all our performance numbers up to the end of August, all the detail and news up to the 27th of September. And as always, this presentation is prepared for clients of McGregor Wealth Management. So as a warning for those of you who we're not advising, you should seek advice before acting on anything that we talk about. What we're going to cover today is the latest in economic news. There's not much change. There's the same themes going on and on, but we're at this turning point around interest rates. So I'll spend a bit of time there. We'll reflect on what that's meaning and what's happening with interest rates, property shares, and put all the news into context as always. The biggest news economically around the world in the last month was the US Fed dropped their cash rate by 0.5%. So this is the first drop. And you can see my little top left-hand chart here, you can see that the rises in interest rates from literally down to zero when the whole world started rising post-COVID. And the US stopped, about 18 months into it, but you can see how much higher they were in Australia. So even though they're dropping, their cash rate is still higher than Australia. In Australia, the RBA governor, Michelle Bullock, is taking a tough stance. She wants to see inflation lower. There's a bit of debate about whether the inflation numbers that printed, and you can see Australia, we've got our inflation rate under 2.7%, but 0.5% of that is effectively the government handing out $1,000 on everyone's electricity bill, which has the effect of lowering temporarily electricity prices. So it's kind of those that have criticised it have criticised it for two reasons. One, it's an artificial measure. Two, it's put more money out in the economy, which is inflationary. Either way, it is what it is. Michelle Bullock's not buying that number till she sees other things go down, and that's why you're seeing a bit of spin being put on by Chalmers and all the politicians and Michelle Bullock. But she's doing a pretty good job. Australian rates will probably follow. You can see in that top left-hand chart, New Zealand's come down, UK's come down, US come down, Europe's come down, China's long since come down. Australia will be one of the laggards, but we were last into the inflationary cycle here, and we may well be last out. But the war's won. You go back a year, we were talking about inflation at 6 to 9% around the world. We're now talking about 2.5 to 3.5. So it's not something that should be overly concerning. Now, what's interesting off the back of the rate cut is people go, oh, this is the good news, bad news cycle you've heard me talk about before. So what causes them to prompt rate cuts? Well, it's the economy slowing down, and slowdowns can border on recession. So you'll see this market that's hypersensitive because we get this bad news that's economy slowing down, but it's actually good news because it means the interest rates that have been high have been working, and it's done the job of slowing the economy down, which will slow inflation down. So it's not a surprise. This is exactly what you want to expect. The top right hand little chart here shows what's happened to shares once we start rate cuts. So there's 0 days there. And we can see that shares on average have done pretty well post rate cuts. There's been times where the rate cuts have been triggered because the market's been entering a recession. So the brown line's there. So not so good. But yeah, up to 30% returns off the back of rate cuts when there's been no recession. So no recession this time would be you've heard people talking about a soft landing. So that's good for the share market. But when you look at that chart too, you'll also see there's a massive range from +30 to -20. So as usual, all things are possible. We've got just in Australia last week, Labor and Treasury are exploring potential changes to the capital gains tax discount and negative gearing. I believe they're testing the waters. The Greens have been holding them to ransom about making changes to these things so that they'll support their social housing policies. And Labor's very stuck in the mud on this because neither the coalition nor the Greens will support it, so they can't get it through. The changes to those things are very controversial. Most investors benefiting from negative gearing are not necessarily wealthy individuals, but regular mum and dads with one or two investment properties trying to get ahead. The CGT discount was brought in to allow for inflation. So if you buy a property and it goes up just by inflation, without a CGT discount, you'd pay tax on that gain. So originally, when they brought in capital gains tax in 1985, cost bases were indexed with inflation to avoid the inflationary gain, but it was all a bit complicated, and Peter Costello brought in the 50% discount instead. So if that disappeared, the government would be making money from inflation. Not something I believe is wise. I also think at the moment changing these things would be bad for the supply in the property market, in the investment market, which would exacerbate the housing crisis. And that's my view. But I say that with my bias of being a very active property investor and with clients that invest in property as well. But I think the answer to the housing crisis, and I'm going to talk about that when we get to the property section, is dealing with some of the supply issues as well as incentivizing investors to build more affordable housing. US election coming up. You can see it's narrowed. It's become more interesting. This is the betting odds in this red and blue chart there, and you can see Harris in theory above. If you're reading any of the international press at the moment, you'll note that narrative around the election is completely different depending on which media you're reading, from the more left-leaning Democratic supporting media to the extreme right Trump supporting media. It's so hard to get a view on what's actually happening. I don't mind this stuff because in theory it's the bookies. So the bookies are independent. They only compare about making money. So in theory they should be the most accurate. It certainly doesn't mean they're going to be right. And at this stage we've got just over 6 weeks to go. So we will know soon enough. Bottom left-hand corner there shows the predictions of where rates are going in the States. So getting the cash rate from up around that 5% where it's been down to about 2.5. The Aussie cash rate 4.35. So we started lower. As I said, 90-day bank bills, 10-year bonds, none of them have changed too much. They're down a little on the 10-year bonds. I'll talk about that some more in a minute. Inflation's down in the zone, but artificially pushed down somewhat, but still the right direction. No change at all in mortgage rates, although we're starting to see these are the sort of the variable rates I've got there. We're starting to see some fixed rates emerge in their fives, the 2 and 3 year level. So that means the banks are kind of predicting that rates are coming down a little. So it'll be interesting to watch that. In terms of the portfolios, the yearly numbers at the moment are sitting very healthy in the teens, from 14% roughly, the high growth portfolio, down to 9% for the conservative portfolio over that 7-year window. Good numbers that are consistent with what we model when we're helping to plan your futures. So portfolios consistently delivering. We've got the markets at a little over fair. So we've got the dial up to 9, which is that zone where it's just a little bit over fair to not quite expensive, but certainly above the averages. None of that is meant to be predictive. It's just an assessment, which helps us gauge, particularly when we're putting new money into the market, the speed of which we should do that. So I added last month an exciting life, boring money segment to highlight a lot of the things that we don't do. We're very good at dodging dark alleys, dodging big mistakes in investing. One that looks to be emerging at the moment that we've deliberately avoided is private credit. APRA announced this month that they're stress testing private credit in Australia, and they're particularly worried about Australian super and pension funds, the industry super funds in particular. All of them have extensive exposure to private credit. Private credit's not a bad thing, but there's pockets emerging that might well lose money. Last month, I highlighted Australian super lost $1.5 billion from one of their private credit deals. So it's like a hidden bit of the iceberg because they don't value private credit on a regular basis like bond markets. When it does blow up, it's unexpected and it causes grief. There was a heading in Bloomberg during the month too that was saying private credit faces worst reckoning since 2008. And the increase in the amount of funds going into private credit has blown up since 2008 as banks were regulated tighter to do more normal lending, and that place for the aggressive lending has been taken up by private credit. So it means private credit is effectively lending to people who can't get the best bank rates. So we've deliberately avoided that. So we will watch on with interest, but not any risk for our clients. And I think it's been a good move. Yeah, the wall of worry continues into new highs. So we've broken through over the last month or so into new highs. I'll talk about what new highs mean for the market shortly. Sometimes people get worried that new highs means must go up, but important to remember gravity in financial markets is not a flat line. So normal is not flat. You'll see that dark blue straight line I've got through the middle of that. That's gravity. That's the normal pace of markets going up. So as we get all this ups and downs in the wall of worry, we do oscillate back towards that upward line. So new highs are just, just part of the cycle. I'll talk more about that in a moment. And let's go to yeah, the bond yields, 10-year bond yields, which are important always as just an indicator of market confidence, but where they see the future, and these yield curves are showing rates dropping in the next 18 months, and then the longer term maturities, sitting around that 4% for 10-year bonds and that type of thing, which is probably that 3 to 4% will probably be the new normal. How long that lasts for once we get through this cycle, who knows? I won't talk too much about that except to just repeat our model that we look at the market through is that wall of worry, because we know that history shows we go through 80% of the time, 90% of the time, the market's in that wall of worry where we're worried about everything, but we wobble up the hill with that gravity that I talk about of markets going up. Occasionally we stop worrying, we have a boom. That's the irrational bit. That's fear of missing out, FOMO or greed. Then we have a bust. The bust is always overdone because of fear, then a rebound, and then back into the wall of worry. That cycle has played out since man has had markets, from whatever sort of markets there's been. So certainly over the last 300-400 years of modern history. That's all driven by psychology. That's why we measure our money on the move pendulum, just to show where we think the world's at. It's not predictive, but it just helps us make smart decisions when money's got to be come in or out. And as always, we remind ourselves that the sun always does come up. Markets continue on with that upward gravity that I talk about there. So as always, there's lots of ways for everyone to mess it up and try and highlight what's happening at the moment. And I think, we'll get this short-term focus at the moment, which is often always the case, by the way, particularly around US presidential election, trouble and strife in the Middle East, Russia, Ukraine, and the turning point of interest rates combined with market highs. So I found this article during the month, which is from Schroders, and obviously they're fund managers. So this is supporting what they do. So potential confirmation bias. But they had some good statistics on the US market that I thought I'd share. And it was whether, these are the bars down the bottom, the blue and the green, and what happens to returns forward 12 months to 24 months and 36 months. So 1 year to 2 year, 3 years after market highs. And there's not much difference. In fact, in 1 year, it's slightly better from highs. And when you look under the bonnet of that, so since January 1926, the market was at an all-time high, 354 months out of the 1,176 months, which was 30% of the time. So new highs are normal, once again, because gravity takes us up. Gravity is not flat in investment markets. Gravity takes us up. So you can expect to be at that new high level, but 30% of the time, and it doesn't change returns that you'd expect from there. So often people have this misguided fear that new highs mean markets are going to go down or crash. Now, inflated highs can do that, and that's why we have our dial to measure there, but not just plain old new highs. It's taken a while to get to this new high, by the way. It's been a grind through that wall of worry. So I've highlighted the bias in my behavioral biases this month, which goes hand in hand with that short-term focus, which is recency bias, which is where we tend to overweight current information. So the flash crash we had last month was based on a few bits of information that way too much weight was put onto in the short term. So we had this 7-8% drop in 2 days, but was past, that was rebounded from that within a few days because, yeah, when you sit back, that information was not as critical as people think. But often new information seems really critical, but it's just not. Some is. Um, Once again, long-term timing in the market. And I won't dive into any of these today. Let's have a look at the numbers around the market. So Aussie shares, and you can see that flash crash, right before the end of August, recovery, little downturn, then we're back into those new highs there. As we speak at the moment, and we're higher than where we finished August. Yeah, 10-year return sitting at 8%, 1-year returns 14.63. 10,000 invested 10 years ago would be worth around 24,000. A good solid average performance, neither high nor low. And you can see the companies that make up your investments in Aussie shares, the top 10, and the top, as usual, Commonwealth Bank and BHP. But Australian market dominated by the financials and some of the materials companies with a bit of health thrown in with CSL. Into the US market, and it's been a great year, 19%, driven by a lot of the technology stocks we've talked about, and particularly the Magnificent Seven and the big tech that's driven that market up. Pretty flat the last few months. So you can see where we finished August. We're slightly above that now, but it's kind of been flat for 3 to 4 months over there. The stocks, the powerhouses that make up that Magnificent Seven, seeing there, Apple, Microsoft, Nvidia, Amazon, Facebook, Google, in particular, and Tesla's not in there, but does make up that Magnificent Seven. And you can see the power. 10-year return for US shares for us Aussies is 15%. Now, half of that was currency. 10 years ago, the Aussie dollar was 90 cents. So the Aussie dollar is more like 68 at the moment. So 5% of that return over 10 years has been from the Aussie dollar coming down. We're very currency aware. It massively affects US returns on international shares for us Aussies. So we occasionally take action to lock in cheap currency to benefit from the returns, but also then to unlock that lock-in if Aussie dollar ever gets super high, which it's certainly not at the moment. Global leaders, similar bunch, the top 100 companies in the world, does bring in a few other companies, but pretty much the same. And this is in your active portfolio 4 times. So 10,000 to 41,000 over the last 10 years, 23% over the last 12 months. But you can see a bit of weakness in the last few months, that flash crash. And for the top 100 here, it hasn't recovered like the Aussie market. So it's very different. And as I go into US small caps, you can see US small caps. It's funny, 4 years ago, it was our highest performer. It had gone gangbusters, high averages, but it's been, in the last 3 years, you can see it's only averaged 5%. The outlook for US small caps is probably pretty good as we come out of this interest rate cycle. We should see this return to its normally premium position, where we do always expect small caps to outperform large caps over the long run, but not at the moment. Yeah, and you can see that even with that understated performance over the last 3 years, the last 10 years has seen $10,000 grow to 44,000. Emerging markets has been the slow coach out of the world, partly because China dominates this. China makes up about 35 to 40% of emerging markets, and the fact that the Chinese government was restrictive through COVID and did things that investors don't like to some of their big companies has held back. Sorry, and I've gone to goal there. Let me get back to emerging markets. Has held back some of the Chinese companies and some of those tech companies over there, trading on much lower PEs than their US equivalents. But yeah, still represents opportunity. In the long run, emerging markets will often outperform developed markets, and it includes countries like Taiwan, South Korea, India. So it will always have a part in the portfolio. Gold has been just such a good part to have in the portfolio, 22% over the last year. As interest rates drop, gold will become more attractive because the opportunity cost of gold is it doesn't produce any income. So when interest rates are higher, that's a bigger opportunity cost. As gold drops in price, as interest rates drop, that opportunity cost, which just means I'm not getting interest, becomes less and less. So we think gold remains critically important in the crazy world we live in because it's always the the one that goes up when everything else goes down. And it's been a really good solid year for gold. Let's have a look at property. And once again, same, but different. We know the property market goes through long-term cycles as well. We use the property clock analogy, but we know we have long periods of not much, then rapid periods of rise, followed by a rest or a downturn, depending on where we are. The numbers continue to be solid. So in most places, but you can see the 12 months, it's still Perth, Adelaide, Brisbane, 24, 15, 15% respectively. Melbourne negative, Hobart negative, only 1%. And I'll put a bit of historical context around that in a minute. And these are the median values. So it's interesting for the median values of property, Melbourne at the moment is below Brisbane and Adelaide and Perth. Now, this is the median value of all properties. So the fact that Melbourne has more units than those other things brings it down a bit, but it's unusual, and I'll talk on that in a minute. You can see here, to put into historical concepts, some slides from our friends at Benari came from the recent conference I attended, show us the amazing historical perspective, of prices in Sydney, Melbourne, Brisbane, and Perth on this slide, going from 18,000, 11,000, when we had a population of 12.5 million up to where they are today. So this is house prices. So you can see here, Melbourne's house prices are above Brisbane's and Perth's, because that we're talking just houses now, not units. But the gap between Sydney and Melbourne is pretty big. Once upon a time, that gap was always minor, but it's as big as it's been. So whether that's telling us Melbourne will be a value, it's a complicated story. But as I said earlier, I wanted to talk a little bit about why supply. And this once again this was originally out of an AFR article, but came to me from our friends at Benari. But it shows why supply is so constrained. Now, supply is just new houses coming onto the market. And you can see at the moment on the right-hand end of that chart, it's at record lows over the last 25 years. So that means the amount of homes being finished and approved, both of them, it's super low. So we've got no sign of our housing crisis being solved. Sorry, I'll just come back to that. And we're 200,000 short of where we need to be just to keep up with demand of growing populations and everything else. Now, the three issues that they talk about here that have affected that: inflated construction costs. We've had a massive problem in Australia the last few years where labour from the building industry is going into the quite buoyant infrastructure side of things. You're seeing in the news trouble and strife with the CFMEU. That's on the corruption side, but on the normal side, the CFMEU, through their bargaining power, has pushed up the cost of labour in the building trades about 25% over the last few years. And that labour has been also then drawn off into these infrastructure projects. So it makes building houses very expensive at the moment. So people have just stopped. So that's not helping. And it's good for investors because it pushes up the value, but it's not good for the steady of the market. As always, you can see that oscillates. It will come back. Supply and demand. Whenever you push down supply, it will absolutely increase demand eventually. I like this chart. It's always interesting. It shows the median house price, Brisbane to Sydney, as a percentage, and it's fluctuated over the years. This goes back to 1975, between lows of 50% and highs of 75, 80%. And if you read anything from this, is if ever Brisbane's half of what Sydney is, it's really good buying. And at the moment, 63% is somewhere in the middle. So probably good buying compared to Sydney. But it shows that all markets in Australia don't move together. So there's always value somewhere in Australia just because of the way that the markets move out of sync. And this one shows a similar thing with Melbourne and Sydney. And the chart here, you can see the increase, that 50% gap between Melbourne and Sydney prices hasn't been larger for a long time. Now, a few reasons. One, they've put up stamp duty down there, so it's caused some short-term grief to prices. But yeah, some of the positives on this going forward is that Melbourne still catches a lot of the overseas immigrants. So 2023, 181,000 people moved to Melbourne. Often we get interstate immigration out of Melbourne, but Melbourne still catches it. So Melbourne's will continue to grow, which will put upwards pressure on that. Just approval, there's been less investor activity in Melbourne, part of that is because of the higher stamp duty. Yeah, so you'll see a lot of that investor activity. The loans of WA, Queensland, only 6.3% in terms of growth in Victoria. And yeah, that Sydney premium is high. That will probably send investors towards Melbourne in the next year or so. And rents are rising. So I own a few properties in Melbourne. So I watch rents stagnate since COVID, but they're on the rise again. The market's getting healthy, and I fully expect Melbourne to be a decent investment opportunity, which I'll come to again in a minute. Now, not much happening here, but you can see on the left-hand chart here, fixed rates are starting to drop a little. It's not huge, but that's the banks starting to position themselves for the falling interest rates. There was a slight drop in the variable rates, but it's like 0.2. So we're really waiting for that RBA rate cuts to start, and that will kick those down, but not much happening at the moment. Certainly not worth locking in fixed rates at the moment, because it's more than likely they'll be down. But the only time exception of that for locking in fixed rates is when it would help you plan and budget. So if you're buying a property or anything and a 5-year fixed rate makes it work and you just want to not have any uncertainty, sometimes fixing because of certainty is a good reason if uncertainty would throw you out. But at the moment, yeah, you would have to want to do that purely for cash flow management. So yeah, there was an article here that talked about how can values continue rising with high interest rates, and it's all those things I talked about. Yeah, there was a stat that came through, and I don't have the stat here, but it as a slide, but the stat is a third of purchases in the Australian property market last year were made with cash. So people are transitioning from one property to another. They've got cash. So interest rates are just not affecting them. This is particularly prevalent at the top end of town. Yeah, so the more expensive properties, there's less borrowings involved. So interest rates are just not as much as a factor. It's more of a factor at the lower end. But if you also look at the fact that rents are so high, so you've got younger couples comparing high rents versus high interest rates, there's not much of a difference. So lots of them are coming into the market to buy, even though interest rates are high, because the alternative is rents are high too. And there's a lot of inheritances going on. So bank of mum and dad or grandma and granddad is helping. We have lots of conversations with clients that are retired that are wanting to help in some way their kids or grandkids with housing, and we're seeing that hold up prices as well. Our friends at Performance Property, who are brilliant in helping us acquire good quality investments property, this is how they see the world at the moment. You'll note the blue cities here are what we would call, or what they would call foundation assets, and it's to hold forever, or longer than 10 years. And then you've got assets you might zip in and zip out, the smaller markets. So Perth's still sitting in a good spot. You've got a lot of regional Queensland and some bits of regional Victoria at the value end. You'll see Sydney and Melbourne probably moving towards the end of their stagnation. I would expect them to go into that buy value thing if they're not there soon. Particularly Melbourne, because it has lagged behind. It will soon look to be value, I suspect. That's pretty much it. Let me wrap up as always that just on our core beliefs that investing is always best done as part of a real plan, and a plan has your goals based on what's important to you. The portfolio then designed to meet that goals to achieve reasonable results over the long run. We do take a long-term view. Then we use all the boring stuff, diversification, just the right asset allocation, and enough liquidity to ride you through markets. We achieve our consistent good returns predominantly through low-cost index investing, about 70%, but not all of that, because there's times where the indexes can take people over a cliff, as we saw in the fixed income space. We avoided that pretty much completely in the care portfolios. And then we do protect against that short-term volatility with the reserves for our retired clients, and by just consistently averaging in for our wealth builders. And rebound, the boring stuff again, rebounds regularly. And as always, there's only 3 ways to lose money in the market. One is panicking, selling, and bad times, having to sell at the wrong time, and not properly diversified. Thank you for listening. Appreciate your attention on these things. And yeah, the world's an interesting place at the moment, but don't lose too much sleep on the investment side of this. Yeah, we've had good results, and I think they'll be expected. We're always vigilant. There's always clouds ahead, but it's the long term that matters. Rob McGregor signing off.